It's a very fertile environment because nobody is getting any benefit out of currency. In real terms, your currency is losing buying power, and debt instruments in real terms are not delivering you alpha. So this is a very fertile environment for gold. We have the deliverable goods. I think that's why we've had a rush on LBMA. We've had the rush to get gold in America. I think we're hitting those skid moments where uh, being able to take delivery and people asking for delivery and trust is gone. And that all goes with the debt market turn, which is what I said was so important. The beginning of the fiat system failure, the fiat and debt system failure, sees trust go away.
Interestingly, a historically strong correlation exists between U.S. debt and gold prices. Conclusive evidence shows that when the U.S. national debt ballooned from $5 trillion to $35 trillion, gold prices rose by 10 times since 2000. That's a whopping gain of over 826% since the beginning of the century. Interest in buying gold can rise sharply in times of uncertainty as anxious investors seek safe havens for their money. Technical analyst FrancisHunt views gold's recent surge as part of a broader bullish trend, expecting further gains after a brief consolidation before the next breakout. He expects silver to gain momentum amid growing shortages and losing trust in the financial system. On a relative basis, that edged the price of safe haven gold in industrially useful silver down towards 88, the lowest since New Year. Based on recent trends, Hunt explains that debt and currency are losing value simultaneously, creating a highly inflationary environment. The U.S. government's budget deficit in 2024 was $1.8 trillion, which pushed the country's overall debt to some $36 trillion. Some financial analysts suggest a debt load of that size simply isn't sustainable, especially given the Trump administration's legislative priority of making current tax cuts permanent and increasing spending on immigration enforcement, measures that would increase the deficit further. A recent survey of small businesses raised numerous red flags about the economy, including trends toward potential stagflation pressure. President Donald Trump keeps companies guessing about what he will do next regarding federal layoffs and tariffs. As we move forward, Hunt compares today's economy to the 1970s, when debt devaluation and currency weakness drove gold to $800. He cites the yield curve inversion, rising unemployment, and declining property values as signs of a downturn. Experts said that the rush toward gold makes financial sense. The asset offers investors a hedge against uncertain stock performance, since gold prices often indicate independence from movements in equities markets. Now, we present the clips of FrancisHunt's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think a gold chart is most certainly due. Before I move on to it, I do just want to highlight that when you devalue a fiat and debt Ponzi scheme, you have the debt and you have the currency, and it's a seesaw. We've had the debt collapse. Now you're going to have a little bit of the currency. So it's a left, right, down, and down, and down. So what's actually happening are both are devaluing. The buying power is devaluing. It's going to be very inflationary. And at the same time, you're going to have a recession. That is your determination of stagflation. It's very poor to weak growth with stubbornly high inflation. There's some people that are getting that wrong. I have some people in mind that are referring to stagflation as, strong growth. It's a poor growth environment inside an aggressive high single digit inflation, and who knows in real terms. So stagflation is incredibly fertile ground for gold. That's what the 70s showed us when Volcker had to devalue the Vietnam debt. What he did is push the rates up, huge debt devaluation. And then subsequently, the currency also took a turn to take a bath after that. And that's what led the gold run up to the $800. So let's bring up the chart and take you into that for sure. I also want to highlight, while we're waiting, in clear evidence that there is already a beginning of loss of unemployment. Unemployment is a lagging indicator. So whilst we look at the gold chart, I want to highlight we've had the yield curve inversion, which we've spoken about many times with us, a leading indicator. It reverted back positive. So I think the last time we spoke, that had already happened. So that is why when I last spoke to you, I said, we're on notice now for correction. And the lagging indicator, the last, is unemployment. And we're starting to see the houses in Washington, D.C., there's twice the usual amount up. There's a 21% collapse in value. And on the airlines, government travel has been cut by 50%, and that's knocked on to around a 20% reduction in revenue in certain cases, leading to a halvening of the earnings per share. So the leverage there is very high. That means airlines can go down and you're getting the property squeeze in the localized area. There's going to be contagion from this generally, and that's why I think we're in that stagflationary negative growth even is possible here in real terms. And it's a very fertile environment because nobody is getting any benefit out of currency. In real terms, your currency is losing buying power, and debt instruments in real terms are not delivering you alpha. So this is a very fertile environment for gold, and we've seen the benefits of it. This is a short term after the recent high run. It's a little too short term, I would argue. If you look at the bigger time frames, this is absolutely phenomenal performance. We got the 3,000 run. This was a technically we would call this another, you had another squeeze. It's been a while since we saw you. This is typically how you go up. We did warn that you'd have a pause period on this target area. You can see you went up, you had a reasonable pull down. It hasn't been for that long, and you wound up, and now you're ready. So we typically expect a continuation pattern in a macro bull, and you got one, and it's traded up. Question, and another point to highlight is I'll start you off on the gold silver ratio, the comparable. And there's only been one moment really in modern history where you've got to 92 and haven't turned down. And that was the events, a very unique set of events. That was CV19. So that was your sell-off when you were there in July. This is when you had a real blow-off, and that was the failure point, and you traded 128. That's ridiculous. It was extreme. And of course, paper, you traded 11. I think the lowest cost you got was 14 or 15. Every other time we hit 92 on the gold silver ratio, there's been a sell-off. This particular event, we almost let go of the 75, and then it got bought back up. Gold was the aggressor and won out. We just hit 92 again, and we've been rejected again for this. So we're caught in the 75-92 range. As long as we're bouncing around in there, silver's going to roughly replicate gold's return, although it's not done so for the 5 years before. So that's why it's not made the new highs. When you swing down leg from 92 to 75, silver will be outperforming. I think that goes without saying. And when you rally off the 75, it's going to be the gold that's outperforming. What you might get if silver firms up a little more and starts to come down is once the recession is confirmed by the lagging indicator of unemployment, you might then get the gold do better than silver again one more time. But eventually everybody's going to realize it's badly in need. There's been a lot of news about shortages, and eventually you've got to be able to deliver the goods, and that's the big thing. I don't think we have the deliverable goods. I think that's why we've had the rush on LBMA. We've had the rush to get gold in America. I think we're hitting those skid moments where being able to take delivery and people asking for delivery and trust is gone. And that all goes with the debt market turn, which is what I said was so important. The beginning of the fiat system failure, the fiat and debt system failure, sees trust go away. Now people want to hold. And when people want to hold, they want delivery. And this is a great problem for derivative markets, banks, etc.
In the interview, FrancisHunt explains that bond market turmoil signals a rejection of the fiat and debt-based financial system, leading to renewed interest in gold. He notes that rising rates temporarily mask the debt crisis, but the traditional 60-40 portfolio model has failed. Gold ETFs led the focused commodities Morningstar category to $4.7 billion of inflows, their best month in nearly 3 years. A financial storm is brewing. The 2008 crash may soon repeat itself, and both stocks and crypto could face a devastating collapse. With alarming signals across housing, stock ratios, bonds, and debt levels, the market is showing clear warning signs. If history is any guide, 2025 could bring a financial disaster unlike anything we've seen since the Great Recession. As confidence in U.S. debt erodes, Hunt suggests gold repatriation efforts may set the stage for a Fort Knox event to restore trust in the system. Let's get back to the interview.
What we've actually seen is the right sizing of America. The people are starting to get more clarity on policy on the new administration, which was actually incredibly limited. They didn't have the wiggle room. In fact, Janet Yellen stood down with almost an after me the storm type statement. You're going to need emergency measures from here, on the basis that the debt markets had been very, very violently rejected the tail end of 2020 and have sold off for the better part of 3.5 years. I'll always start there, and there's a reason, because if people understand the dollar is not in isolation, it's borrowed into existence. So the foundational level is in fact debt. So you have a UST stroke USD system in America, and in the UK you have a gilts or a UK GB 10-year stroke pound, and so every nation is like that. When you get the heavy rejection of the asset class or the reserve asset class, and there was a lot of dropping of that phrase in recent politics, as a debt instrument, which is the 40-year bull market that has ended, what you're actually getting is a rejection of the entire fiat and debt system. However, because rates spiked, it's not immediately apparent, because you actually had relative dollar strength over the last 6 months as a result of the higher rates that were in existence on the debt system. And that's kind of hides the fact that the debt was in a chronic collapse. And the key thing about the debt markets in 60-40 portfolios and everything as an investment is that it was stable, boring market. Bonds are meant to be boring. They meant you create the alpha with 60% in the equities. And when the equities went down, money flushed into the bonds, and you'd get a couple of percent over inflation in real term growth, and you'd get paid a little bit of a yield as well. So bonds would outperform a little bit. They were kind of counter-cyclical. It would balance out the volatility, meaning on a risk-adjusted, volatility-adjusted basis, the 60-40 portfolio was actually a better performance than being 100% equities. Now, that 60-40 portfolio model actually took over from a model that used to have gold in it, which was the insurance against proliferate governments. And of course, they said this isn't required anymore. It underperforms, it doesn't pay any interest, etc., etc. We had Gordon Brown's bottom, which is known as the Brown bottom, where he sold or changed the name on the clipboard at least, all of Britain's gold, or 400 tons thereof, at about 250 odd $53. So what we've had in the post CV19, this is the setup, is since the rejection in values, you can't have a 45-50% correction in bonds. It hasn't given you what equity markets has. It hasn't done an Nvidia or a Mag 7. This is a rejection of the system. So the rates gave you the dollar strength that masked that for a while, and it reduced the inflation slightly on imported goods for Americans. But in actual fact, the reserve asset as an investable reserve asset has now been rejected. And this has been, okay, so what do we invest in since? We've got hyper-valued equity markets because all the bond money flowed there. It's quite a binary situation since, the advent of the 60-40 portfolio. You don't want to pay over the odds for a ridiculously priced equity that's got 100 plus years of earnings already baked into it in its price. So we've started to revert back to the original reserve asset, and gold is being rediscovered, but not by retail in any meaningful way. It's the central bankers. And it's particularly the central bankers that have to deal with America that have rediscovered it. And more recently, since Donald Trump and Elon Musk has come in, even American central banks rediscovering it, which is probably behind the UK and silver gold. I don't think we've spoken since those movements were occurring. The repatriation of some degree of gold back to America may be the setup for some form of show and tell Fort Knox vault event, let's just say, to rebuild confidence. Because when debt markets fail, it is the underlying foundation of the home that is the fiat debt-based system, and that is confidence failure. You can fail further up and you can have stock market crashes. That's all well and good, and there's many people that have been trained to buy the damn dip, but I can say this is a deleveraging and a right sizing of America, because the possibility and the scope to spend what it spent before, it's not a positive message. I'm sorry, guys. We've had this incredible expansion, which has been based on liquidity feeding on liquidity, and now the unwind of that, the Goldilocks Greenspan era, is now facing the J. Powell's let's say Night of a Thousand Knives type era. And unfortunately, it's not very positive.
Still, experts caution against putting all your eggs in one basket. Not everyone agrees that gold is a good investment. Critics say gold isn't always the inflation hedge. Many say it is, and there are more efficient ways to protect against the potential loss of capital, Given the ongoing debt crisis and rising uncertainty in global markets, are we on the verge of a major financial reset in which gold reclaims its role as the ultimate store of value? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.